If you've been in the metals markets recently, you'll have been in for what has been a bit of a rocky ride. We saw initially some action from China, which brought prices back. And then, of course, we had this rise in the dollar, which has also been a negative impact on some of these dollar-denominated commodities. Let's get some more details now and some more depth on what's happening with John Meyer from SP Angel. John, welcome. I know we've spoken before about the trials and tribulations of the metals markets. Just to run through what it is you're seeing as an analyst and someone that runs a house that's interested in this particular area of the market. Just explain what has been happening along the route over the last 6 or 7 weeks or so.
Well, it's been a particularly interesting week from a metals perspective because what we've seen is metals building up to very high levels, or relatively high levels. Copper breaking nearly a 10-year high, I think. And then the prices pulling back. We had the Chinese government criticizing and publicly blaming metals for the potential to lift inflation in China, describing it as a threat, particularly describing it as a threat to small and medium-sized enterprises, and that they saw raw materials prices feeding into higher inflation in China, and that they weren't going to stand for it. And of course, when a government like the Chinese Communist Party says it's not going to stand for something, heads normally roll. So what we've seen, one of the points of attack is the iron ore price. Iron ore prices have been up at over $200 a ton. When you consider it costs on average about $30 a ton to produce iron ore in Australia, that's an enormous margin. It's not the sort of margin one would normally expect to see, even in a bull market. So China has threatened to dump or to sell metals directly back into the market. So they have a strategic stockpile, the SRB, which they can use to offload metals into the market. And in fact, they announced yesterday their first sale of copper into the markets, just I think 20,000 tons, which is about $185 million worth of copper. No, it's not going to move anything. In fact, the market pulled back, particularly pulled back in copper and the base metals, also pulled back in the precious metals as well, in anticipation that the Chinese might look to punish the markets. And I think what really was happening was Western funds just decided to go a little bit more cautious. They also had the situation with the Fed, which made some various comments about potentially raising interest rates. And so a lot of the people holding these metals said, well, we don't need to stand in the way of this. We can go into other asset classes. So there was a bit of profit taking, probably a bit of short selling as well in those metals. And then what we've seen over the last 2 days is actually a bounce with metals prices pulling back up. And what I think is going on is the market said, and when I talk to US hedge fund commodity traders, they say to me, well, the China can sell a lot of metal, but then it will have to buy it back again. So we'll still see ongoing strong demand for these metals driven by stimulus in China, and particularly driven by Biden's go big stimulus in the United States. So we don't think the super cycle for metals is over. In fact, we don't even think it's really broken.
John, let me just pick up on the point you made about copper, because I want to take a look at this in specific, and I'll bring up a price of copper on the London Metals Exchange. Now, you were talking to us about this from the 4-year lows that we saw, which was the COVID low point, actually, down at something like around about $4,300. Since then, we've seen this rise. In fact, you were, in my experience, one of the first people to identify 10,000 as the reasonable price target. And indeed, we got beyond that. I think at that point, you were then talking about towards the 11,000 level. You said it would be a rocky ride. And this is indeed what we're getting. From what you've just said, can you just tell us any more about how you see things developing from here? Because if what you say is right, and we are still not through this super cycle, what sort of upside should we consider? And how are we going to get there? Is it through demand? Is it through lack of supply? Is it a mixture of both? Is it China behaving more rationally in terms of wanting to buy up surplus? Where's the demand and where's the price action going to come from?
Well, it's always going to be demand driven in terms of price appreciation. But but we are also seeing supply interruptions. We're going to see a lack of investment in countries like Peru and Chile, where they've elected new socialist governments and new socialist ministers. And so we think that's going to end up disrupting supply. We know there's a lot of logistical disruption going on in the world at the moment. We can see that container rates going from China to the West have gone up by 3 times, even 4 times in some cases. And it's not just that the rates have gone up, but the availability of those containers is difficult to source at the moment. So we're seeing stories of shipments, particularly of lower quality goods, piling up in China because they either can't afford the shipment or they can't get the containers. So there is, I mean, if we add to that the situation with semiconductor chips, which has been slowing automotive production lines around the world, we do see a little bit of a pullback in demand, but it's very temporary, to be as I see it. And so we think there's a slight delay in some of the demand growth that we were looking for, but it's only a slight delay. And I think whatever the Chinese government says, and they can jump up and down as much as they like, I still think we're going to see higher metals prices going forwards, particularly in the base metals. Where I think China can win is with iron ore, because iron ore has been driven higher almost entirely by local Chinese speculators on Chinese futures exchanges. So I think the Chinese government can quite easily somehow work to pull back the iron ore price, and that will save them many billions of dollars a year. If they, for example, if the iron ore price halves, I think that would save them something like $100-200 billion a year.
Talking about these two metals together, just remind us why the markets are so taken by copper. What is it? Where's the demand coming from? What is it we're going to be doing with the copper? And I'll ask the same question about iron ore, because it's presumably a very different sort of area of demand from where it's coming. Just explain more about what sort of uses these metals apply to.
Well, both commodities are driven by end demand, which and in the case of iron ore, it's construction, it's stimulus projects, and in fact, the worse the world economy gets, the more stimulus projects are announced. So iron ore, so yes, that's different. Copper is often referred to as Dr. Copper because it leads the complex, and the reason it leads the complex is because it's used so widely in so many different things. So from air conditioners to wind farms to fridges and freezers and all, or just into general construction, copper is very integral. So if you increase the price of copper, you can you're automatically creating price pressure on a whole range, very broad range of goods and services that depend on copper, as a key component. So if you double the price of copper in an air conditioner, you are going to add a little bit onto the cost of producing that unit, and therefore that tends to feed through into the price to the consumer. Now, what's going on in the world is the retailers in the West are absorbing some of that. Manufacturers in China are also absorbing some of that. So we haven't seen a lot of inflation yet. But I think we've got to the point for other reasons where actually these manufacturers want to feed the commodity price pressure through into higher prices. They just use it as an excuse. The real reason is we've come out of a pandemic, and workers and employees want better pay and they want better conditions. And there's a lot of movement in the jobs market at the moment, and people are saying, we want, if there's going to be another pandemic, I want a better house to live in, for example, or I want a bigger salary so I can have a better car. Whatever it is, people want a bit more, and that, I'm afraid, that is probably more inflationary than anything else.
Let me just take a look at what's happening as well with another metal that's certainly been in view recently, and that is nickel. We've seen a pullback there, but in fact, I think if anything, nickel has made a little bit more of a recovery. What is it about nickel that we should be aware of?
Nickel never gets the credit that it deserves. It's quite hard to find from a mining perspective. When you do find it, it's quite expensive to produce it. And there's lots of technical challenges with the mining and production and processing of nickel. And actually, as a metal, it's remarkable because whether you're making a fuel cell or an electric battery or some other electrochemical device, you almost always use nickel. I mean, you could use platinum or maybe even palladium, but of course they're very much more expensive metals. So if you want something that's easily available and is tough enough to stand up to the corrosive environment of a lithium-ion battery or a fuel cell or something like that, then nickel is your key component. In fact, it's almost always the heaviest component within that electrochemical device. So nickel is really important to the electric vehicle revolution. It's going to be very important for vehicles using hydrogen and fuel cells, and also for fuel cell power generation in office blocks and in housing developments, for example, which I think is something that's coming to us. So really important metal, and very hard to find more of it.
In terms of some of the companies to watch, I know at SP Angel you have a lot of clients that deal with these metals. Just explain a couple of companies you should be looking at in terms of some of the metals we've discussed.
Well, nickel is difficult to find, so that not so many companies that do it. Horizonte Minerals, not one of our clients, but has a number of nickel projects in Brazil, which isn't a bad place from a mining perspective. Or Amur Minerals, which has a strategic nickel deposit in Russia. I mean, it's such a big deposit that it is classed as strategic, but they've had that project for many years, and they are making slow progress with it, unfortunately really quite slow, but it has enormous inherent value or in situ value in the ground.
What about copper? Companies to watch for?
Strategic Minerals is developing copper production in South Australia. Rambler Metals and Mining is developing improving production at its Ming mine in Canada. Phoenix Global or Phoenix Copper is developing a copper project in Idaho in the United States. So there are a number of counters to play in the London market within the smaller area.
Yeah, and just wrap it up with a look at iron ore as well. I mean, some of these big companies, of course, the really big players get involved in all these metals. So there's obviously a play with some of the larger companies like Rio Tinto and BHP, of course. But what about iron ore?
Well, for iron ore, it is all about the large companies: BHP, Rio Tinto, Anglo American, and even Glencore have a little bit. And for me, iron ore is more likely to collapse than go much further ahead. I mean, it's been extraordinary how high the price has risen. It's extraordinary that the price has managed to stay up there. But I do think this is an area where the Chinese government will be able to restrict speculative investment in iron ore, and I think that is more than likely to pull the price back.
Yeah, look, John, thanks so much indeed for bringing us up to date with what's going on with the latest there, and of course also the inflationary element to that, and what the Fed is telling us. And of course, we've got today, as we speak, the second day of the testimony from Jay Powell, so we're expected to hear more about that and his views that potentially inflation might actually be transitory. It was John Meyer from SP Angel. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.